Namaskara. A very pleasant good evening, members. Hearty welcome to each one of you for today's study circle meet on the topic Practical Insights into Standards and Auditing. Today, to present on this topic, we have very eminent speaker, CA Chinnaswamy Ganeshan, sir. Hearty welcome to you, sir, on behalf of Bangalore branch. Members, just to inform you, I would like to take a couple of minutes about our future programs during this month. On 11th of March, we have breakfast meeting on the topic Indirect Tax on Virtual Digital Assets from 8:30 a.m. to 10:30 a.m. I request all of you to kindly register. And the next Wednesday, we have study circle on the topic TDS updates. Then 18th March, we have hands-on training on Excel for bank branch audit. We have workshop. Then we have 25th March, we have one-day seminar on bank branch audit. So I request all of you to kindly participate and encourage us to do more further programs. With this small intro, I would request Secretary Manjunath Hallu to kindly give an introduction about our speaker for the day.
Thank you, Chairperson, for that welcome address. Good evening, members. It is my privilege to introduce today's speaker, CA Dr. Chinnaswamy Ganeshan, sir, for this August gathering. CA Dr. Chinnaswamy Ganeshan has started his practice as a chartered accountant in the year 1988 and was in personal practice till 2005. He then served as director in Lovelock and Lewis network firm of PwC for 6 years and as a partner in BSR & Co. LLP network firm of KPMG for 6 years in the audit practice. He is presently the senior partner and head of audit and assurance of Messrs. CN, GSN and Associates LLP, Chartered Accountants, Chennai, a firm with 11 partners and around 120 team members. Ganeshan specializes in financial reporting, including Ind AS, IFRS and US GAAP, company law matters, audit and taxation, and was conferred honorary doctorate for his extensive contribution to Ind AS and IFRS by a renowned foreign university, and also is a recipient of the Jewel of India Award for his role in financial services and Certificate of Excellence for his contribution in the field of financial services. Ganeshan has presented more than 1,350 papers at various seminars, workshops, and conferences, both in India and overseas, on these specialized subjects. He has also authored a quick referencer on IFRS with model question and answers, the revised Schedule 6, Ready Reckoner, Ind AS quick referencer, and Ready Reckoner for financial statements under Schedule 3 to the Companies Act 2013. Ganeshan is closely associated with the Institute of Chartered Accountants of India for last 20 years and is a guest faculty for all its 5 regional councils. He was a co-opted member of Accounting Standards Board, ICAI, and Ind AS Transition Facilitation Group. He was also co-opted member of the Ind AS Implementation Committee of ICAI and Auditing and Assurance Standards Board of ICAI. He is presently a co-opted member of Executive Committee of Institute of Directors, Chennai. He is in the Board of Studies of the Department of Commerce of the Shivnadar University and University of Madras and Tyagaraja College, Madurai. With this brief introduction, I present before you CA Dr. Chinnaswamy Ganeshan, sir. Over to you, sir. Sir, I think you're on mute.
Thank you, Chairperson, and the Secretary and the office bearers of Bangalore branch for giving this opportunity of meeting the friends virtually on this important topic on standards and auditing. I think my PPT is visible for you, right? Okay. You know that the standards on auditing is required not only for the purposes of doing an audit of a company, but also for a non-corporate entity as well, because it directs you how you have to do your audit. It also guides you how you can effectively do an audit, efficiently do an audit, and defend the work you have performed during the course of the audit. When we are talking about insights into standards on auditing, we are not specifically talking about a particular standard, but on an overall basis, trying to cover what are all the standards on auditing and how it is being placed for the purposes of our application in respect of the audit and any other work which we are supposed to do. When we are looking at the standards on auditing, you may see that general terms we are using is standards on auditing, but within standards on auditing, we split that into standards on auditing, standards on review engagement, standards on other assurance services. Like that, we split the entire activity based on the particular type of work which we are carrying out for a client. When we do audit, we use standards on auditing. When you are doing limited review, we are using standards on review engagement. When we are doing an agreed upon procedure or any other work we are doing, we are using the standards on other review engagements or other assurance services. So that's the way in which overall the auditing standards have been structured. In our discussion, we will concentrate more on the standards on auditing rather than review engagement and other activity. And you are at liberty to ask me any questions at any point of time. I will be happy to take it. But at the same time, if some questions are going to be discussed at a later point of time by me, I will take it at the appropriate time rather than taking it immediately, so that the flow of the program or flow of the presentation is not getting disturbed. With these few words, let us see how we are structuring the entire discussion. First of all, when standards on auditing are applicable to the auditors, entity, etc., that's the first thing which we will look at. Secondly, what are all the key auditing standards which we are supposed to look at when we are doing an audit? And what should be the audit process which we are looking at when we were carrying out an audit of an entity? When we say we are talking about an entity, we are actually saying that the entity may be a company or maybe a non-company. That's the way in which we are actually structuring ourselves for the purposes of this discussion. And thirdly, what are all the practical issues connected with the standards on auditing? We will inbuilt this at every point of time or every slides where we were discussing. And if you have any specific questions, we will also take it up during the course of the presentation. Now, when we are talking about the applicability of the standards on auditing, the first thing which we are looking at, size is not influencing any engagement. Meaning what? A smaller audit or bigger audit, the procedures which we have to adopt or the standards on auditing which we have to adopt is not changing. What will change is actually the extent of the audit procedure which we will perform. So the size of an entity or size of the engagement will not be influencing the way in which the standards on auditing should be applied for the purposes of an audit. So audit, in simple terms, is an audit anyway. So that means whether it's a smaller audit or a bigger audit, the auditor has to necessarily comply with the standards on auditing. Second aspect which we are talking about is, even for a smaller entity, when we are doing an audit, when we are saying smaller entity, maybe it is a partnership firm or it's a proprietary firm, even in that particular scenario, the audit of that smaller entity may be required by any statute. For example, when we carry out the tax audit, again, for a smaller audit, we are actually carrying out tax audit under Section 44AB of the Income Tax Act, but we are issuing an audit report in Form 3CB. Form 3CB, if you look at, it actually contains two portions. One portion is talking about the Form 3CD and its particulars. The first portion is talking about what is the opinion on the financial statement. When I say that opinion on the financial statement, we are actually giving an audit opinion for the user of the financial statements, even though it's a partnership or maybe even a private proprietary concern. So accordingly, even for smaller entities, the standards on auditing is essential. That is the second point which we have to look at. In fact, if you are looking at a company, then we have Section 139, subsection 10, which says that the standards on auditing should be mandatorily applied in carrying out an audit of an engagement of a company, audit of a company. That means statutory authority also say that standards on auditing is mandatory for the application. Section 139, subsection 10 of the Companies Act very clearly says, till such time specific standards have been developed by NAFRA or Ministry of Corporate Affairs, the standards on auditing issued by the Institute of Chartered Accountants of India will be considered as the standards on auditing under Section 139, subsection 10. And accordingly, when you write an audit report for the purpose of a company, you will refer the standards on auditing as prescribed under Section 139. When you are issuing an audit report for other than a company, non-company entities, you will be talking about standards on auditing issued by the Institute of Chartered Accountants of India. And for your information, as of now, there is no difference between these two. Only thing is, there is a legal authoritative status comes in respect of the audit of a company because of Section 139, subsection 10. Okay. Otherwise, the standards on auditing is similar. What we are going to discuss for smaller entity, we are going to discuss for bigger entity. Absolutely, there is no difference between these two. And even for a smaller entity, the transactions are becoming more and more complex. We may be having only purchase and sales, but if it is a company or which is a smaller entity, maybe a partnership firm, which is in export of goods, wanted to hedge the possibility of forex differences for which they might be entering into forward contract. The moment you are entering into forward contract, the concept of mark to market is coming into the picture. The guidance issued by the institute that if there is mark to market losses, it should be immediately recognized in the profit and loss count. So even if we are considering very small type of entities, the business transactions are not just straightforward, simple, but they are becoming more and more complex. In that situation, application of a standardized set of principles for validating the sufficient appropriate audit evidence and based on which we are issuing an audit opinion becomes very, very critical. And in fact, if we carry out the audit in accordance with standards on auditing, two things we will achieve. One, it is more efficient, meaning we carry out the audit with quality. Secondly, it is more effective. That means I can do the audit within a particular period of time. I will need not do over audit. I need not end up with having a lesser audit. I will be doing what is required and I will complete the expectations of all the regulators. And even if my file is subjected to any review, peer review or FRRB or QRB or even NAFRA cases, in all these cases, my documentation can very easily evidence that I carried out my audit in accordance with standards on auditing. And to that extent, I need not worry about any of the review questions which may be asked by the reviewer. So smaller entities or bigger entities, nothing is that. As I have already said, the moment you are saying that there is a guidance which is available under the standards on auditing, naturally it helps you to ensure that you are saved in case of any possible litigation arising out of the audit. Maybe if the reviewers are saying that you have carried out your audit negligently and audit quality is not maintained. In all those cases, your work papers and your work carried out in accordance with the standards on auditing will help you in defending your case. So that's the reason why we are saying the standards on auditing is very crucial whenever an auditor is supposed to carry out his attest function. Having said that, let us also look at the various services which are being provided and whether there are any standards on auditing or any standards which are connected with that particular activity. I have carried out the nature of service which I am doing is audit. That means statutory audit or tax audit or any other special purpose audit where I am issuing an audit opinion which states that the financial statements are fairly presented or it contains a true and fair view of the financial position, financial performance, cash flows of the entity for the given point in time and given period of time. So that is an audit. Second is, I do not do a detailed audit, but I do only a limited review. So I question I inquire the various stakeholders involved in that company, and with that stakeholders' questions, I corroborate with the audit evidences to ensure that what they are saying is acceptable to me as an auditor. But at the same time, I'm not issuing an audit opinion because I have not carried out a detailed audit. I carried out only a limited review. In case if I have carried out only a limited review, in that case also I issue an opinion, but that opinion is called a limited review report. This is audit. Limited review is also to some extent an attest work which we are doing, but there are other activities also which auditors are doing. For example, if a client is engaging you only to carry out an audit of the fixed assets of the entity, then the fixed assets entity validation may not be considered as a full audit, may not be considered as a limited review, but it will be carried out based on what is the objective for which the client is asking you to do that activity. And accordingly, you agree certain procedures to be performed. Based on the procedure performed, if there are any exceptions, the auditor factual presentation of the exceptions, he is actually giving that. It is not an internal audit. It is basically something specifically agreed. These are all the procedures which I will carry out, and this will be the outcome. And out of this procedure carried out, these are all the observation. Factual presentation of the observations will be done. That we call it as an agreed upon procedure. And another area is called compilation. The client gives a trial balance and he requires a financial statement. You are putting the trial balance into a balance sheet, profit and loss account, cash flow statement with all notes on accounts, etc. But you are not doing any audit. You are not certifying that it's audited by you, but you are saying that it's only compiled or a trial balance has been converted into a readable financial statement format, compiled into a financial statement format. Now you will understand that audit is a detailed one. Limited review is to some extent a lesser level of review of the work. Agreed upon procedure and compilation is specific work which is being carried out. Whatever you are doing, if you are looking at, it will automatically fall into that. For example, if you are issuing a certificate, it is also an agreed upon procedure. Based on the agreed upon procedure, you are certifying certain matters, right? Now the question is, when we carry out the nature of audit, what is the assurance we are providing? Audit is a detailed exercise, and accordingly, we give a high level of assurance on the fair and true presentation of the financial statement. Okay. At the same time, we are not giving absolute assurance. In a certificate, we are saying that it is true and correct. Whereas in respect of an audit, we don't do that the financial statements are true and correct. We are only saying that the financial statement does not contain any material misstatement either due to fraud or error based on the audit procedure. So we give high level of assurance, but not absolute assurance. When it comes to limited review, because we have not carried out a detailed work, we give only a moderate assurance. In agreed upon procedure and compilation, we do not give any assurance. We are only describing the factual observations made in agreed upon procedure and saying that we have simply compiled the trial balance into a readable format or presentable format of a financial statement. So the level of assurance we understood. Now the question comes is, what type of report we give? In an audit, we give a positive report, positive assurance that the assertions that true and fair view has been maintained. It does not contain a material misstatement, etc. In a limited review, we are saying that we have not carried out an audit, but based on the procedures performed, nothing comes to our knowledge that the financial statements have been prepared with some material differences. Two negatives, when I put it becomes a positive, so that means it doesn't contain any material differences. Agreed upon procedure and compilation, as we have said, only factual findings and identification of the information which has been compiled into a readable financial statement. Now the question comes is whether standards on auditing is mandatory in respect of all these services. The answer is yes. Only difference is in respect of audit, we use standards on auditing. In respect of review, we are using standards on review engagement. In respect of agreed upon procedure and compilation, we are using standards on other assurance services or assurance engagement. SAS, SRE, SAE. That's the way in which the entire technical guide or technical standards issued by the institute falls into place. When we do an audit of a company or when we do a limited review, we will quote what is the standards based on which we have carried out this entire work. So for example, when I do an audit of a company, we say that we carried out our audit in accordance with the standards on auditing prescribed in section 139 subsection 10 of the Companies Act. And what those standards requires you, that is also you explain. In respect of limited review, you are saying that we have carried out our review in accordance with standards on review engagement 2410 or 2400, depending upon what is the responsibility or what is the way in which the auditor has assumed his role as an auditor of the limited review. Agreed upon procedure and compilation, you will go with the respective SAEs, standards on other assurance engagements, right? So in all the cases, it is applicable, but when we specifically talk about standards on auditing, it is applicable only for audit engagements. What the auditing standards are guiding us. The standards on auditing says that the auditor will carry out a risk assessment. What is a risk assessment? When I do an audit of a retail industry, what are all the risks associated with the retail industry? Maybe inventory obsolescence could be an issue. Cash management will be an issue. Sometimes cash may be embellished by the employees, or trade receivable may be a point of issue. But when we are looking at the other areas, property, plant and equipment, you will not have any major issues relating to that. Similar to that, on the profit and loss account side, when you are looking at, the major point will be on your purchases, on the debit side, and on the credit side, what is your sales. So you are trying to understand what are the risks associated with each of the line items of the financial statement, whether it's a balance sheet item or it's a profit and loss account item. You are trying to understand the risk associated with that. If it is a retail industry, what is the risk associated with sales? Cash sales is involved. Credit sales is involved. Whether credit parties have been properly selected or not could be a possibility of question which you may have. Now, for that purpose, the standards on auditing says that the auditor will be doing an assessment of risk involved by understanding the entity and the environment in which it operates. So now let us look at this understanding the entity and the environment in which it operates. When I say understanding an entity, nothing but understanding the business of the entity. If I'm an auditor of a manufacturing company which is in automotive sector, I should know what are the business risk associated with the automotive industry. I should understand the business, whether it is highly capital intensive, highly labor oriented, data's collectability is an issue. When you are having an export, what are all the related incentives and other things which will be coming in? What is your labor cost which you have to consider? What is your cost of goods sold? What is your inventory valuation? What is your depreciation charge? All these things could be a possibility which we have to understand. For that purpose, the starting point is we should understand what is the business of the entity. That is what understanding the entity. By understanding the business alone, we will not be getting the complete comfort. Sometimes a business may be working in a particular environment where I will not be able to compare the same industry which is working maybe in an industrial area which is well established, and another industry, another company within the same industry working in a backward area. I cannot equate them. And I cannot consider a company or industry which is operating in a state where the political stability is there. In another area, the political influence is very high. In fact, when we were doing even the assessment of a non-banking financial services company, especially microfinance and other companies, one of the way in which we are trying to identify the environment in which it operates is what is the legal framework. RBI regulated, then what are all the other laws and regulations which you have to look at, and where you are operating, which state you are operating. In that state, is there any concept of ringleader? That means in that particular locality, somebody is operating as a leader and he commands the entire people to follow a set of rules. In the case where you are going and doing your business, the ringleader may try to impact your business by his influence. And in that process, if you are not able to consider that risk, you will be into trouble. Similarly, in some cases, the political parties may also influence the way in which your financing activity is there. For example, in some of the states where the elections for the assembly has happened, the first point discussed during the audit assessment is what is the poll promises they have given. In the poll promises, they have mentioned that any loan which has been taken by the farmers below a particular threshold limit will be fully written off. That means they have applied that rule for cooperative societies. Will they actually extend to a non-banking financial services company in a private sector also is one of the assessment which we have to carry out. And they have brought in some restrictions on or concessions on a write-off on gold loans. Then the NBFC, which was in gold finance loans, has to be looking into that environment in which it works. So the general approach, in other words, is looking at your client is doing a business and you are going to do an audit. Have you understand the risk related to the business, the demography in which you are operating? And of course, it also adds one more additional point. When you do an audit, what is your audit procedure? Is it based on control testing or it is based on validation of each and every transaction? So we call that as a substantive audit procedure. Normally, the standards on auditing says if the internal control system is very strong, the auditor can do a lesser substantive audit procedure, vouching, verification of documents, collecting the audit evidences, etc., can be limited. It need not be very extensive. because the internal control already takes care that there will not be any transaction which will not be tested by more than one person. Okay, the entity is internal control. This is basically the foundation for analyzing any risk related to an audit. And then when we assess or identify a risk, first we are identifying and assessing whether the risk will result in a material misstatement. Suppose if we believe that there is an issue with respect to the controls and that controls will result in some misstatement, but it is very, very negligible. Trivial errors may be possible. I'm not saying that errors have happened. Possibility of error, risk of error, risk of material misstatement, whether it is material or not material. If it is material to the financial statement, we have to look at very seriously, because your audit opinion is saying the financial statements are free from material misstatement. And it also says whether due to fraud or error. Error is unintentional, fraud is intentional. The question is whether the auditor should always look at only finding out the errors and the auditor need not worry about fraud. Unfortunately, the standards on auditing says that when I'm doing an audit, I need not do an investigation. I need not go with a suspicious mind that everything will be wrong. Somebody might have committed a fraud. I need not do that. But what is more critical for me is that I should factor the possibility of something go wrong. Something may be misused by some people, or some transactions are misstated by people intentionally. That is called a fraud. So either due to error or due to fraud, the auditor has to consider fraud factors. In some cases is mandatory. For example, when you are doing an audit of revenue, it says that the area susceptible for fraud risk, revenue is considered to be a fraud risk area. And accordingly, auditors should perform minimum fraud risk procedures to ensure that the sales are properly stated. There is no bogus sales, there is no understatement of sales. The auditor has to do certain activity. So we are starting with the understanding of the business, entity, internal control, based on which we are identifying and assessing whether that becomes the possibility of risk of material misstatement. ROMM is normally the standards are using risk of material misstatement, ROMM. Okay, I looked at the possibility of risk of material misstatement, whether it should be looked at the financial statement as a whole, or is there any other guidance? The guidance says financial statement as a whole is your primary responsibility. Because it's a primary responsibility, if you are looking only at the financial statement, when you do the line item of the balance sheet, like property, plant and equipment, inventory, current assets, non-current assets, investments, etc., or on the liability side, borrowed funds, share capital, or statutory liabilities, trade payable. When you are doing this particular line items, if you are looking only at the macro level, financial statement level, the possibility of aggregation risk comes in. Say, for example, one error might have been observed in trade receivable. Another error might have been in your property, plant and equipment. Another error may be on your investment. Individually, they are not material to the financial statement, but when they are clubbed together, aggregated together, that becomes a material misstatement. And accordingly, the risk of material misstatement has to be assessed at the financial statement level as well as at the assertion level. Now, I'm using a new terminology, right? Assertion. Assertion is nothing but fundamental promises the preparer of a financial statement gives to the user of the financial statement. For example, free of fraud, free of error. One of the commitment which they are giving. True and fair view, true and correct. These are all the promises they are giving. On what basis these promises or assertions are being given? They have been split into three different categories: balance sheet objectives, transaction level objective, presentation and disclosure level objective. In any of these area, the promises given is not in accordance with the standards on auditing, there is a possibility of a risk of material misstatement. That's a level also we assess. We will look into this little further in the ensuing slides. Then, based on this risk assessment, the auditor has to plan his nature, timing, and extent of the audit procedure. In other words, in a simple terms, the auditor should plan for his audit program or audit strategy. Audit strategy overall level, audit program detailed level, a disaggregated level, asset, liability, within asset, what are all the items like property, plant, equipment, investment, trade receivable, cash and bank balances, etc., right? That you will be doing this line item wise assessment, which will be detailed audit program. In that audit program, you have to design and implement responses to the assessed risk. I started with the understanding of the client's business, the environment, its internal control, the possibility of something goes wrong into a material misstatement, either at the financial statement level or at assertion level, due to fraud or error. Having assessed that these are all the possible risks, what is my counter? What is my weapon to prevent or mitigate that result in a material misstatement? So that validation or that mitigation is nothing but responses to the assessed risk. What is the normal responses to the assessed risk? One could be the auditor will decide what is the nature, timing, and extent of audit procedure to be performed. The auditor may simply look at normal vouching, or the auditor may be interested in getting an external confirmation from major debtors, all bank cash and bank balances. All these things could be a response to a assessed risk. For example, if I assess a risk of fraud in inflating the sales by bogus invoices, the simple audit response is receiving the aging analysis of trade receivable and validating the subsequent realization, as well as getting a direct confirmation the trade receivable. What will happen? Client gives an aging analysis. Based on the aging analysis of the trade receivable, we will understand that if there is a long outstanding debtors, why it is not collected? Is it a credit risk which has to be provided for, provision for doubtful debts, or in India's scenario, expected credit loss, whether we have to make a provision for that particular purpose. And when we are doing this long outstanding balances, it might have been collected subsequent to the balance sheet date, but before you complete your audit. That is a very clear evidence that the debtors are genuine debtors and they have also been collected. No provision for doubtful debts is also required to be done. That is also the auditor comes out as part of his requirement. And this is a second thing. When you are getting a direct confirmation where the balance is not yet subsequently collected, you wanted to have a confirmation from the third party whether the balances are genuine balances or not. If the third party also confirms that the balances as outstanding in the books of the client is matching with the books of the party, then it gives an evidence that you can rely on the trade receivable balance. Okay, so you plan or you create a response for every assessed risk to ensure that the risk associated with the risk of material misstatement is reduced to the acceptably low level. It is reduced to minor errors. It is reduced to below the material level, material misstatement level. So that is the overall or macro approach on standards and auditing in respect of an audit. This standards and auditing will be done at the planning stage, will be used at the execution stage, will be used at the completion stage when you are preparing your audit report. So in all the three stages, the standards and auditing are applicable and gives a guidance how you have to do that. Okay, let's look at a simplified audit approach based on whatever we have discussed. What is the simplified audit approach? You can use it, or without knowing, you might be using this in every audit. The first thing is we are trying to find out or going with what is the risk which are very high possibility of risk of material mistake. Top-down risk-based approach. Highest level of risk, which will make the financial statement wrong. Next highest level, next highest level, next highest level, and what is the lowest level? Top-down risk-based approach. High-level risk areas, you will employ very detailed audit procedure. Medium level, you will employ lesser audit procedure. If it is trivial or low level, you may even decide not to carry out any detailed audit procedure, only overall test check. You may think about it. So based on the risk assessment. And based on this top-down risk, you will very clearly identify what is the key business drivers, what makes the company profitable, what determines the profitability of the company. If something goes wrong in that particular parameter, for example, if I'm talking about my selling price remaining fixed, but my input price is very, very volatile, my entire risk or key business driver is how the company controls the raw material cost, how it has a proper purchasing policy, and what is the way in which it negotiates to pass on the increase in the prices of raw materials to the customer. So this is translated from the top-down risk-based. Identifying the risk will be on your cost of goods purchased because of the volatility of the pricing, and you cannot pass on the increase in this cost price to the customer by means of increasing the selling price. So I have identified that as a key business driver. Another area, I'm not a company which is dealing with products. I'm only doing services. When I'm doing services, the major cost which I will incur is my staff cost or employee cost. So in that case, what can go wrong is if the employee cost is not properly audited and accounted for, the financial statement may be having a material misstatement. So I identified that as a key business driver. So top-down risk approach, and I'm linking it with the key business driver. And in that key business driver, high, medium, and low, what is the probability of it resulting in the likelihood of a risk of material mistake? When I'm saying probability, it's a likelihood. What is the likelihood it will become a risk of material misstatement in that particular area? See, for example, in one of the client case, we have seen that in one particular year, the cost of material consumed has significantly increased by 12% compared to the previous period. Every year it was around 58%. This year it was around 70.24, something like that. So our worry is the selling, the market has not changed. Selling price remaining the same. And we have seen that similar companies are not having, or similar industries are not having 72% or 70% of cost of material consumed. They're remaining to be at 57 to 59%, which was my normal average in the previous years when I'm validating the company's financial statement. All of a sudden, how the 12 to 13% has happened. So our risk of material misstatement, top down is cost of material goods, cost of material consumed. So the key business driver is how the purchases are accounted for. When we validated the purchases, we have identified that in month on month, we have done a small way analysis. Is there any major issue arising in a particular month? In one particular month, we have seen that there is a spike in the cost of material consumed. So we looked into that particular month and identified that there are a lot of imports during the particular year in a foreign country. When we have checked the prices, I mean the import invoices with what is the accounting which they have done, we have identified that the invoices have been very wrongly accounted for because the system is actually asking the customer or the client to select what is the currency, INR, US dollar, euro, pounds, Japanese yen, like that. They have given multiple foreign currency. While the normal purchase of this company's imports are from UK and Europe, where sterling pounds and euro are used. During the particular month, they have imported mainly in US dollar, not in euro and pounds. But the purchase clerk, when he has entered the transaction, normally he has a feeling that it is normally euro or sterling pound. He selected euro or sterling pound instead of US dollar. When the US dollar was around 60, 65 rupees at that point of time, the euro was around 102, 103. So 40 rupees per unit, currency unit, there is an increased purchases which has been accounted for. Once we have identified one issue, we check the another invoice. There we have found an error. So the error, when it is occurring only once, we normally consider that as a human mistake can arise. When the second mistake also identified with the same style of mistake, we call it as a trend. The trend may be unintentional. So every time when he is entering the transaction, blindly he is entering that as an euro transaction. Or it may be intentional. He wanted to do a wrong entry. But in this case, it's not intentional. It is a human judgment that everything could be an euro import. So we have taken all the euro imports, all the UK sterling pounds imports, compared with what is the currency they have selected for that in SAP, or maybe even in Tally also it is possible to have that currency unit. When they have done this, when we have analyzed the transaction, we have identified that in all the cases, US dollar has been used as a currency unit instead of euro or sterling pounds, as the case may be. Because, euro and sterling pounds have been used instead of USD. Because of that, the purchase price have hiked, jumped. When they have validated the closing stock, they have validated according to the previous year work paper, which is nothing but nothing but US dollar. So they have done that properly in validation. The consumption has increased significantly. So the assessing and evaluating the key business risk, likelihood of risk of material mistreatment has to be identified, and based on which you have to assess at the assertion level. We will see what is the assertion level in another 2 slides downwards, we will see. In this case, what I have done is an assertion is whether the transactions have been accounted properly. Valuation is properly. Valuation is one of the assertion or one of the objective or one of the promise which the preparer of the financial statement gives to the user of the financial statement. We assess the risk, and based on that mapping, decided what is the nature, timing, and extent. The nature of audit procedure, we have decided that all the import invoices will be verified, irrespective of whether it's a small one or bigger one. Timing, the month for which it has actually having a big spike in the purchases, that we have taken. And the extent, almost 100% of the invoices. So that is the way in which we have decided. Target testing of all the import invoices. Timing will be a particular month where that is a big spike. And thirdly, all the invoices will be verified. So that's the way in which the nature, timing, and extent, or NTE, is what we call. And that being executed, and based on which the work is completed. Every audit procedure which you are looking at, every audit procedure which you have carried out, knowingly or unknowingly, or even when you don't wanted to say that I have carried out an audit, but I don't know whether I have applied the audit procedure. In that case also, you will be able to understand that you have really done all these things. Only problem which I have seen is that whatever we have done, if it is properly documented in accordance with the standards on auditing, your work is not questioned. You have carried out all the work but you don't have a documentation. The standards on auditing on documentation says, SA 230 says, if there is no documentation, it is presumed that you have not carried out any work. That is where majority of our fraternity are getting into problem whenever there is a review which is coming by the regulator. We are not able to support the work we have performed by means of an audit documentation. Okay, so just look at this simplified audit procedure and how you can support by means of your audit documentation. What may be the key requirements when we are looking at the financial statements? As we have seen previously, financial statements, even for a smaller entity, may be required for the purposes of submission to the bankers when they have taken a loan, or financial institution when they have taken a loan. It may be even for a non-corporate entities or non-company entities, not necessarily for companies. Similarly, there is a possibility of these entities, smaller entities, are subjected to income tax audit, maybe tax audit, presumptive taxation, etc., where you may be required to carry out certain audit procedure to issue an audit report under Section 44AB. It may be a smaller company, small and medium-sized company, or small and medium-sized enterprises. In all these cases, depending upon the level of turnover, you may be required to do an audit even under the Income Tax Act. And another thing is, we have another set of standards called Income Computation and Disclosure Standard. For the purpose of computation of your income from business or profession or income from other sources, you have to apply these standards for computing your income and for making disclosure in the tax audit. So in all these cases, we are carrying out some sort of audit or otherwise. And accordingly, there should be a guidance available. There should be a procedure which I can use by means of a standardized process. That standardized process or standardized template are codified, and they are called standards on audit. So that's the reason why we always believe that standards on auditing is important. What are all the key requirements on standards on auditing when we are looking at? We are considering audit because we are talking about standards on auditing. Standards on review engagement, if I am talking about, I will talk about limited review. Here I'm talking about audit. When I'm doing an audit, what I am doing, you remember that I have talked about risk assessment, understanding the business and its environment, based on which I assess what are all the risks. And for that risk, what is the reporting, what is the responding to the assessed risk, what is the audit procedure, what is the way in which the risk, which is very high of material misstatement, is brought down to acceptably low level. So that means we are eliminating the possibility of error in the financial statement by identifying the errors and passing the entries, audit entries, or sometimes preventing the mistake being happening, how we are taking care of the audit procedure. And there could be a possibility of certain reporting requirement. Under the Companies Act, we have a reporting requirement under Section 143(3). We have a reporting requirement under CARO 2020. We have a reporting requirement for internal financial controls, etc. So what is the reporting requirement? If I'm doing a tax audit, the reporting requirement goes completely different. So understanding the reporting requirement, my audit procedure will also be done. So this audit procedure which has been designed will be performed. We call it as an execution stage. The audit procedures are performed to obtain sufficient, appropriate audit evidence to demonstrate that the financial statement does not contain any material misstatement, either due to fraud or error. We collect the required evidence. Whatever we have collected, whatever we have done should be documented. That is one requirement of the standards on auditing. And based on that work performed, we have to create or we have to give an audit opinion. Friends, here I wanted to take up one live issue. One of the case, where a practicing chartered accountant came to our office for helping them in responding to a show cause notice issued by NFRA, National Financial Reporting Authority. The National Financial Reporting Authority has reviewed certain issues or certain complaints they have received from SEBI or complaint lodged by a whistleblower. They were looking at what is the work performed by the auditor. Wherever they have felt that the auditor's work is not in accordance with SA, they are saying that you have not carried out the audit in accordance with SA 200, SA 230, SA 500, SA 505, SA 620, SA 700, 705, 706. Like that, they have put down so many standards on auditing and said your audit is not carried out in accordance with the standards on auditing, which you have said as the basis for your audit opinion under section 139 subsection 10. Since you have not carried out your audit in accordance with the standards on auditing, you are not entitled to give an audit opinion at all. Your audit opinion is not having any basis. That's a level of interpretation when work papers are not supported with the work performed in accordance with the standards on auditing is there. And accordingly, a simple process, just use that. So don't immediately think that audit becomes so cumbersome, audit becomes so risky, whether I have to give up audit and go only to advisory role. Don't think so narrowly. I believe that if there is a challenge, there is an opportunity. If there is an opportunity, it can be converted into a professional engagement. If it is converted into a professional engagement, your possibility of revenue also goes up. There is no risk. Everything is simple. Like, why is that client should pay you audit fees which you wanted to demand, right? Based on the risk appetite also, it is actually goes inside because you have to do a lot of audit procedure, right? So what is the only thing which we have to do? Simple knowledge of the standards on auditing and simple application of the standards on auditing in planning, execution, and completion. Only 3 areas. There are set of audit standards. There are set of objectives you are looking for. Just to look at those items and document what you have performed in your work paper, that is enough. You will be withstanding any test of regulators. So it's very simple, nothing to worry too much on that. Now, when I'm doing an audit planning, again, what I'm trying to do is, what are all the relevant standards on auditing, which I have to apply? Maybe in the planning stage, execution stage, at the end of the audit completion stage. Secondly, what is the various accounting standards which are applicable to the particular entity and whether the accounting standards have been properly complied with. When I have standards on auditing relating to how trade receivable has to be done, validated, how bank balances are to be validated, how inventory has to be validated. Naturally, there is a related standards on auditing. Accounting standard also I have AS2 on inventory, which requires that inventory should be properly valued, right? So the application of accounting standards is also critical when I'm doing an audit, based on which I perform the audit procedure. Fraud risk, as we have said, SA 240 says that the auditor should always consider the possibility of fraud risk in an audit of a financial statement. Reason is, if everything is fine, but somebody can override that controls in one single day, intentionally or fraudulently, and the auditor is not factoring that, there could be a possibility of a fraudulent financial reporting. And accordingly, fraud risk should also be assessed. And accordingly, the procedures to be performed for assessment of fraud risk, you should always have what is the responses for the assessed fraud risk, how you are going to do that. And what are all the significant estimates involved in an audit? For example, if I'm only looking at a company which has 2 major items, one is their property, plant, and equipment, another is their employee cost. I always look at how the depreciation economic useful life of the asset has been considered. It's a significant estimate. Secondly, when I'm talking about the employee cost, I look at what is the way in which the employee costs are validated to ensure that there is nothing missed out. So how to audit a significant estimate? There is a standards on auditing is there. And in some cases, you will be relying on the work of an outsider. For example, you are relying on a report issued by an actuary. What are all the work you have to perform to rely on the work of an other person, third person, maybe an internal auditor, maybe another audit firm who is doing the branch audit. You are doing the audit of the head office and you are going to issue a consolidated report. How you are going to rely on the work of the others. So you plan your entire work and employ or carry out nature, timing, and extent of audit procedure to address the risk of material misstatement, bringing it to the low level, and document the entire work you have performed by means of SA 230 guidance. SA 230 is for audit documentation. So this is what the structure in which the standards on auditing comes out. There is a question, Q&A, somebody has raised a question. Virendra Hegde has given the question. The auditor of subsidiaries has emphasized material uncertainty relating to going concern. But in consolidated auditor's report, this matter was excluded since it is not material. Please advise whether it is a material mistake. Very interesting question. Of course, it comes as part of your completion stage where you are consolidating the audit work performed by the subsidiary and you are doing an audit of the consolidated financial statement. We are talking about whether it's a material misstatement or not, right? When we are talking about material misstatement, at what level we have to consider the materiality? So the subsidiary auditors might have considered the materiality for each subsidiary, their financial statement, the standalone financial statement of the subsidiary. And let us assume, based on the facts which has been given by Mr. Hegde, I assume that these subsidiaries are not very significant subsidiaries. When all these qualifications are, which has been quantified by the respective standalone auditors, have been consolidated, right? Whether it results in a material misstatement, that's what we have to look at. In this case, he is talking about going concern. I will address the going concern a little bit. Before that, let us look at individual errors which has been quantified and qualified in the audit opinion. What would be the situation? What I have to look at, what is the material misstatement at the financial statement in consolidated level? At a consolidated level, if it is not material, the consolidation auditor need not qualify his audit report. Okay, even if there is a error which has been pointed out there. Now coming to this particular scenario, they have questioned the going concern concept of the subsidiaries. This creates two problems for me. One, what is the contribution of revenue? What is the contribution of profit or loss from that subsidiaries? Is it material to the consolidated financial statement? Then there is always an issue relating to the going concern at the consolidated level also, because of dependence or the percentage of your top line, bottom line, etc. will have an impact. So one is based on the level of transaction, whether the subsidiary is material, etc. This will also affect the parent company or consolidated financial statement. The second level which we will discuss is there is a material uncertainty relating to some subsidiaries, but the parent company is well rich. My only worry is what is the level of investment I have made in that subsidiary? Whether those subsidiaries investment has been properly provided for. There ends my matter. Because when we are talking about material uncertainty relating to going concern, the guidance note SA 570, when you are looking at standards on auditing 570 on going concern, it gives an application guidance where it says that if the entity can meet its obligations for the next 12 months from the end of the reporting period. So for example, 31st March 22, when I assess up to 31st March 2023, if there are any demands which are coming in, whether it is possible for the entity to meet its obligation. If there is a demand comes in, whether they will be able to meet the obligation. If there is a trade payable, whether they will be able to settle. If there is a loan repayment has to be taken care, whether they will be able to repay it. If the parent company is cash rich and it can support that particular subsidiary and there is a turnaround is possible, in that cases, you can consider that there is a material uncertainty relating to the going concern at the subsidiary level, but the going concern concept is not impacted or there is no uncertainty at the consolidation level. So materiality of the subsidiary to the consolidated financial statement has to be looked into, based on which you have actually considered this particular item. So on that basis, you can conclude whether it requires a report here also. Normally, I have considered that there is a material uncertainty and provision of investments have been already made. There is no material uncertainty at the consolidation level. Okay, that's the way in which we normally look at a practical level. Now, I said you are looking for certain objectives at the time of doing an audit at the assertion level, or your risk of material misstatement at the assertion level, linking it to the various assets and liabilities. The test objective is nothing but ultimately how the financial statement is going to be prepared, how the asset will be presented, right? So accordingly, it's all simple common questions. I normally used to tell my students, you always use a theory of 10 relevant questions to become a good auditor. Let me start with this. If there is an inventory, which is, say, for example, 10 crore, and in one of the case where it has gone up to the disciplinary committee is that the financial statement contains a word, inventories as certified by the management. Auditor has not made any reference to his audit report or any specific reference in his CARO report. The reviewer picked up that particular point and said, the auditor has not carried out any work relating to inventory. He has simply relied on the work performed by the management, taken the number as given by the management. And based on that inventory, the working capital limits has been given by the bank. Accordingly, auditor has failed to assess the fraud involved in inventory and whether the inventory is really existing as on the financial statement. Actually, the inventory was not existing. That is where the problem has actually happened. So existence means if it is an asset or a liability, is it really exist in the year end so that it should be part of the balance sheet? That's the first question. It seems to be a fundamental question, right? That is the reason why we are looking for external confirmation for debtors, advances, etc., investments, bank balances, cash balances, cash physical verification we are doing only to ensure that the cash balance is physically existing, right? That is one of the test objectives. And if I have to show that as an asset, I should have a right over the asset or control over the asset. Control comes only if I have a right. And similarly, if I have to recognize certain items as a liability, I should have an obligation to pay to others. If there is no obligation, why should I consider that as a liability? So, is there is a true ownership or true liability? A simple example could be when a company purchases vehicles, we normally look at, if it's a private limited company, we normally look at in whose name the RC book is registered. Is it in the name of the company or a director? If it is in the name of the director, how it is recorded as the asset of the company? Is it any personal asset accounted as the asset of the business? We look into the rights and obligations, right? and whether all the transactions relating to or all the assets and liabilities related to the entity for the current period has been properly accounted for. All items are accounted, nothing is missed out. In fact, I can give one example where we have come across a peculiar scenario. We have done an external confirmation process for a bank by sending a letter to the bankers asking them to give what are all the accounts which the client is having with you without even mentioning any account number. We have simply put the name of the company and there is an authorization which has been given by the client. We are listing out what are all the relationship you have, current account, what are all the current accounts, what are all the working capital limits, what are all the term loans you have given, what are all the guarantees you have given, what are all the letter of credits outstanding, what are all the bills discounted outstanding. Like that, we have listed out in various scenarios. When the confirmation has been received, we have identified that the banks have issued a letter of credit worth 2 crores, which was outstanding as on that particular date. Client has never told us that there is a letter of credit outstanding. When we have seen whether it has been completely accounted, no. 2 crore for that company is a material number. Of course, letter of credit is only a contingent liability. Even if a material disclosure is missing, SA 706 requires you to qualify the audit report. Sorry, 705 requires you to qualify the audit. So completeness of all the transactions or all the assets and liabilities being accounted for. Whether they have valued it properly, whether they have accurately valued, is the information which has been provided is also valid. Okay. So that is another question which we are asking for. If it is a property plant equipment, a machinery was there, whether the machinery has been accounted as property plant equipment or it is accounted as inventory or it is accounted as a current asset, whether it is properly classified in the presentation of the financial statement. And how it is presented. Is it in accordance with the required financial reporting framework? For example, when I am looking at the Companies Act, it says that you have to follow Schedule 3. In Schedule 3, how you have to present a particular item in the asset side or liability side, current, non-current, and then what are all the other disclosures required. Whether this has been taken care is your balance sheet objectives or assets and liabilities objective. And when it comes to transaction level or profit and loss account items, we can talk about is whether the transaction has actually occurred. I recognize that sales of say 5 crore in one invoice with one of the party. When I have validated, I have found out that it's a bogus transaction. So why I am supposed to look at occurrence? If the transaction really not happened, it should not be part of the financial statement. Occurrence. Then whether all the transactions happened during the year has been accounted properly. For example, sales which has been made at the year end, not accounted, but accounted in the next year. And we talk about unrecorded liability testing, or whether any expenditure has to be provided for March, but not provided because it's not, invoice was not received, but still you have to accrue. Whether completeness of all the transactions have been considered. Whether information has been accurately accounted for, cut off. The transactions relating to the current year only, it is accounted in the current year. Sometimes what happens is sales might have been made at the year end, but dispatches has happened only in the next year. So to that extent, it is not sales of the current period, it's a sales of a subsequent period, right? Cut-off procedures, you account it to ensure that. Again, whether the transaction has been properly classified into employee cost, into administrative cost, into selling cost, into cost of material consumed, etc., properly classified. And whether it has been presented as required by statute. Schedule 3 gives the format of profit and loss account also, whether you are using that. This is relating to a transaction level objective. Disclosure level, transaction has occurred, there is a right and there is an obligation. Everything has to be explained in the disclosure. Okay. Now, whether all the disclosure which are material to the financial statement has been completely included or anything has been missed. Whether the disclosures have been properly classified, accounting policies. Within accounting policy, what is the accounting policy for sales? What is the accounting policy for interest income? What is the accounting policy for export incentives? What is the accounting policy for inventory? What is the accounting policy for fixed assets, depreciation, etc., etc. So how it has been properly classified to ensure that user can understand the meaning clearly. And what is the way in which it has been properly allocated according to various accounts. For example, if I'm talking about a simple disclosure, there is a disclosure statement called related party transaction. There is a disclosure of cash flow statement. There is a disclosure for segment reporting. In all these cases, how it has been properly valued and allocated and presented in the financial statement. These are all the disclosure related objectives. What we are looking at is whether these objectives relating to balance sheet, relating to profit and loss account, relating to disclosure has been met during the course of the audit. For that purpose, we are looking at key standards on auditing and how it should be applied at the planning stage, at the execution stage, at the completion stage. In the planning stage, we are talking about terms of engagement. That means the auditor should enter into a term of engagement with the client, CA 210. What are all the laws and regulations which are critical for the client's business? CA 250 is talking about. You might have heard that recently in the Code of Ethics, the auditors are expected to check whether non-compliance with any laws and regulations have happened. If so, it has been properly disclosed in the financial statement and its impact has been taken into consideration. For all the listed company, it has been made mandatory. For the other companies, it's only recommendatory in nature as of now. But it is coming out of CA 250, which we are using for years together, right? Next is, what is your audit plan? What is your overall audit strategy? And what is your independent audit plan for each of the line items of the balance sheet, profit and loss account, and disclosure? What is the amount you consider as material to the financial statement? Because we are going to give an audit report, whether it's materially misstated or not, right? So what is material to the financial statement? Decide at the planning stage. And while you are performing that, any error which has been identified is checked with whether it's material or not material. And you evaluate the identified errors with the overall projected error. And that's the way in which you will do it at the execution stage and completion stage. You can do some analytical review. In some cases, you may, like what I have seen, the cost of material consumed percentage has increased by more than 12% in a particular year. When we have done that preliminary analytics, we believe that it should not happen. When it has happened at 12%, we wanted to specifically deep dive into that particular area and identify. That is coming out of CA 520. Now you will realize whatever we are doing, knowingly or unknowingly, we are applying a standards on auditing. Only problem is, if we are looking at the individual standards on auditing, it also gives you what is the application guidance, what is the documentation you have to demonstrate that you have carried out your work properly. That was the only thing which was missing. Otherwise, you might have seen that everything was already available. That is on the planning stage. In the execution stage, you have to collect audit evidence that comes under CA 500. Audit evidence may be collected by inquiry, observation, verification, completely going through the transaction. We call it walkthrough. All possibilities could be a point of collection of audit evidence. External confirmation how you have to send a confirmation request to the bankers, confirmation request to your trade receivable, and how you have to ensure that it has been received, reconciled with the amount shown in the financial statement. If there are any differences, how it has been taken care. Again, SA 505 gives an elaborate guidance. That SA 520, what we have done at the planning stage, can also be done as part of the execution stage. For example, very simple example you can talk about is, what is your rental payments? How many rental agreements you have entered into? What is the period of your rental agreement? Is there any escalation clause? If it is not there, what is the per month rent into 12? If you have 4 agreements, aggregate of all the 4 agreements is expected to be your rental expenditure in the P&L, plus or minus 5%. Could be agreement might have been entered into at the fake end of that, or after entering into the agreement, you got a concession from the client, etc., etc. It is possible, right? In those scenario, by doing only an analytical procedure without doing a detailed vouching of each and every 12 months payments, I can ascertain whether rent has been properly accounted for or not. So that is an interesting way in which SA 520 has been dropped. And it is very difficult that we can do 100% of an audit. So what are all the auditing procedure you can perform using sampling techniques? So that comes as SA 530. Sampling technique can be scientific sampling, or it can be non-statistical sampling. And again, a lot of techniques are available. You can go for a random number sampling. You can decide top 10 items I will 100% validate. For the balance items, I will go for scientific sample testing. All those things is given, the guidance has been given in SA 530. And then estimates audit, I have discussed. SA 540 comes as part of that. Related party transactions are susceptible for fraud, and you have a responsibility to disclose the related party transaction under Income Tax Act, under Companies Act, under ICDs. In everywhere you have some sort of work to be performed, and transfer pricing, if it is there, that is also applicable. So the related party transaction, how the relationship has to be identified, completeness of all the related party transaction is properly disclosed or not. SA 550 gives the complete guidance of how you have to do an audit. The year end is 31st March, but I do my audit in July 2023. In that case, 4 months have already lapsed from the year end, but the events which has happened between 1st of April to the date on which I signed the audit report shows that some adjustment may be required in the financial statement as of 31st March itself. It is an adjusting event which I have to do. So in that case, SA 560 is of complete guidance for you. Using the work of an expert, even when you are relying on the actuary, SA 620 has to be looked into. Interestingly, sometimes you come across some funny situation also. Recently, one audit has been taken over by a reasonably good level of audit firm, because the shareholders agreement very specifically mentioned that the audit should be conducted by, they mentioned the top 10 auditors according to the global requirement. So they have appointed one particular audit firm. In the evaluation, we were also part of it, because we were the internal auditors for that company. So we were part of that discussion, and we were giving some advice also to the board level. So one of the worry which the auditors are having was relating to MSME. MSME, you know that if the dues to medium and small and micro industries has not been paid within 45 days, then you have to provide for the interest on that. What should be the basis for it? The basis should be based on the declaration given by the other party, because I don't know whether it is a small entity or medium-sized entity or micro industry. I don't know. So I circulate a letter to the other party. The other party is not responded to my letter. So I believe that there is no claim which has been received from any parties in the past. If I'm settling within 45 days or after 45 days, and accordingly, the management is of the belief that there is no parties covered under MSME because we are not aware of it, and accordingly, no provision is required. And customary practice also, they have not claimed it. The other party is also ready to say that we are not going to raise anything. Confirmation is also there. But the audit firm has insisted that we have to get a legal opinion on this. Okay, the client has also agreed to take a legal opinion. When the legal opinion has been given, the auditor started asking, who was the lawyer? What is his experience? How we will know that he is competent to give this certificate? Like that, they have asked so many questions. The client has called and said that it becomes a pain to have them. My auditor will be able to understand, the previous auditor will be able to understand what is my problem. But these people are not even applying, they are going by the standards alone. I told that, yes, the standards on auditing requires that when you are relying on the work of an expert, you should assess their competency, their independency, their objectiveness. In all these scenarios, they will ask who is the auditor, who is the person who has issued the opinion, etc. But at the same time, if they are asking you to get an opinion from the topmost lawyer, tell them that I cannot afford that cost. And whatever information they are asking about the competency of this lawyer, give that information, let them validate. So using a work of an expert, even if it's an actuary, you have to apply the principles of SA 620. And when it comes to the completion stage, you have to get a letter of representation, SA 580. But the letter of representation is not going to defend you in case of litigation. I must tell you, because I gave one example where certified by the management, they have said you have not done anything. Management has given a confirmation that all the inventories are existing, they have been properly valued, etc., etc. But that representation is not having any value at all. Please go and look at SA 580. 580 says, what are all the circumstances where you can get a letter of representation? If you are trying to get a letter of representation for everything and you have not having any other audit work paper file, they will believe that you have not carried out any audit. So letter of representation should not be considered as the ultimate protection for anything happens in case of any review. Normally it is, I should always use the phrase, it is not worth the paper on which it has been typed. Now you will understand what is the value of a letter of representation. Unless it is a specific issue where you don't know what is the subject matter, you're relying on work of somebody else or relying on the technical assessment of the management. In that case, you have to think about getting a representation. All current assets, current liabilities, current assets, loans and advances are realizable at the value at which it is stated. Management represented that, and accordingly, no provision is considered necessary. It is not going to help you at all. You are supposed to look at what is the valuation, because one of the objective at the balance sheet level, whether it is valued properly, whether debtor is fully collectible. If it is not collectible, what is the provision relating to doubtful debts? You have to evaluate. The management says are collectible, then that representation is you have not carried out any work. So please look at SA 580, which will help you in understanding what are all the requirements you are supposed to do. Then SA 260, very interesting standard. What it says that when you completed an audit, you are supposed to communicate the various work you have performed, various significant accounting and auditors matters you come across, and what is the way in which it is resolved in the financial statement. You should communicate to the people in charge of the company. People in charge, when I'm saying those charged with governance, means the board of directors of the company. You have to communicate. You may ask a question, whether it is relevant to non-company entities to communicate. There also it is required to communicate for protecting you from possible other issues. In one of the case, in my own case, what has happened was, it is very common. You might have also experienced. There was a search at the client place, and during the search, they have seized some documents. And when they have seized some documents, they have asked, what exactly is this transaction? It seems to be a concealed income or an unexplained expenditure. They simply said, we do not know anything. All informations are known only to my auditor. The department has felt that auditors have advised them to account for that unexplained expenditure or not to account for that particular income, concealed income. So they have given a notice to me. And when I went and show that this is the way in which we are doing the audit end to end, we can verify. Client doesn't have complete information in the financial statement, means they are lacking. And every year when I complete that, I fix up a time and explain what is there in the financial statement, what are all the audit adjustments we have made. Everything is available. And I have then went and created an awareness of the client saying that don't afraid of the department's questions. We are always there to support you, but at the same time, you know the business well better than me, and explain what is the problem. And when I have explained that, you can ask, it's a hospital where it has happened. We have actually told the officer who came for the search and seizure, we have challenged them. Sir, you pick up any one particular person, anyone according to your choice, from the inpatient register who came as for consultation, and how the income has been accounted for all the activities, right from consultation of the audit doctor, consultation of the expert doctors who have been called from outside, diagnostic services, surgery which has been done, operation theater charges, surgeon expenses, medication, and how it has been received, accounted, and how it is collected. I will give end-to-end process. I will take you through that entire process. We have challenged them. When we have challenged them, the client was actually not feeling comfortable. He says, sir, if they are looking for anything, we can discuss and manage it. I said, nothing to worry, sir, because your accounts are clear. Why you are worried about it? Let them select. In fact, it offended the officer who came and selected around 15-20 transactions. And all the 20 transactions, we are able to demonstrate that everything has been fully accounted for, including the TDS has been detected and remitted for the consultant. When we were explaining, the client was also sitting next to the officer, and he is also peeping in and trying to see what is the audit evidences which we are trying to show. Then on the day, I have realized that every year, even if I'm doing a smaller audit, I should go to the client and explain to him what are all the things which has happened. So that actually given by means of application guidance in SA 260. Okay, that is a very important aspect. And finally, when you do analytics, again 520, planning stage, execution stage, in final, you remember that even in our olden days where we were doing audit on a manual basis without using Excel, etc. When I joined in 1983 as an article clerk, and in 84 when I completed the first audit independently for a company, when I went and presented the financials for my senior's review, he looked at the financial statement for a few minutes and said that, Ganeshan, I believe that there is a grave error in the profit and loss account, either in your purchases or in stock valuation. There is something wrong. He gave it back within 5 minutes. I was having a feeling that he is actually testing me, because I have done the audit for more than 15 days as a field in charge along with 2 people. So nothing might have gone wrong in my audit procedure. But when this man with an experience of more than 4 decades is saying this, I was wondering what he is talking about. So we have went back and looked at, and when we have seen that, we have actually seen that the stock valuation was actually not completely reconciled with the stock statements. reconciliation with the stock statement, when we have seen, there is some more stock which has to be included in the valuation. After that, we have went and again represented the financial statements for our senior. The senior said that, I think now it seems to be all right. Then I will review that in detail. Then out of my curiosity, I have asked him, sir, on what basis you have found the mistake before and what basis you are now saying you are comfortable? Can I understand for my learning purposes? He said simply, the gross profit margins are not looking nice. For this industry, I have 3 clients. In all the 3 clients, I was having a gross profit margin of around 42%, whereas this client is reporting a profit of only 23%. So what happened to the 13% is what I was looking for. After you have adjusted or recalculated your inventory, it is coming somewhere around 41%. So industry average has been met. That is nothing but your final analytics. Somebody who is reviewing can apply their mind on analytics and find out whether the numbers are smelling good or something goes wrong into that. Okay, that is also another interesting techniques. And of course, finally, your work should be concluded by means of an audit opinion. So that comes as performing an opinion and reporting based on SA 700, 705, and 706. 700 is the normal audit report, and it prescribes the format of the audit report also. 705 says if there is any modification, qualification, disclaimer, or negative opinion. So when you are having this, how your your audit opinion should be modified, SA 705 comes in. SA 706 talks about whether any emphasis of matter should be included or whether any other matters to be included. That is actually coming in. There is one more question, I think that it has come in this question and answer Q&A box by Anil Kumar Hosabettu. What documentation should the central statutory auditors of a bank have to support the time schedule given to the branch auditors so that they can rely on the report? Very diplomatic question which you have talked about. This is being questioned by many of the auditors now. In fact, there is one movement which has been started where you give only 3 days or 4 days to complete the entire branch audit. What is the quality which the statutory central auditor will get for the purposes of identification of your NPA, anything which has to be provided for, etc. So now the documentation is not on the timeline. The time schedule, even if you wanted to do an effective audit within 5 days or 6 days, you have to engage with the client what you can do prior to the audit and what you can do subsequent to the closure of the accounts. So in end of March, you can do certain work, and after March, you can do certain work. You can actually do interim audit and do the roll forward procedure, etc. on that basis. So time limit is with the auditor, nothing to do with the statutory central auditor. But at the same time, sorry to use this now, with the core banking is available, the statutory central auditor can apply audit tools to ensure that they will be able to complete the entire work even without visiting a branch. That is also possible. So whether branch audit is really required or not is the next important question which is being raised by the bankers. Our worry is that is bread and butter of majority of the practitioner, especially small and medium practitioners. So we wanted to have it. Unfortunately, the worry is with the timeline, whether we will be able to do justice of a proper audit is a question comes in. And of course, you know pretty well whether you are doing a good work or you are not doing a good work within the time available. So you have to plan your work and do it. That is my suggestion on this. Now, when we are coming to the closure of the audit, we have also talked about SA 700, 705, and 706. And finally, there are certain areas where we have to consider as a special procedure. It is almost 20 minutes is only available. What I will try to do is I will wrap up in another 10 minutes time so that we can have some time for Q&A. Special consideration is you should always keep your professional skepticism on, right? And you should think about what is a possible fraud risk and how the management may be having a pressure to show a non-performing company into a very good performing company, and how you have considered that as a possible area of risk of material misstatement. What are all the recent development in accounting, economic developments in the country, and based on which anything which will have an impact on you. For example, in one of the audit committee, we have asked a question that what happens with the poll process in that particular state which has been announced, whether the poll promises of the political parties, because the opposition party was saying that when we are coming to the power, we will write off loans below say 20,000 rupees. And another was saying that any loan taken on gold for less than 4 grams will be fully written off. These are all the poll promises which are given by the ruling party, the opposition party. We asked, with this going to happen, whether the promise has been going to be fulfilled or not subsequent to the election, subsequent to their being elected. But our worry is, in case if they are serious enough to implement that particular poll promises, what would be the impact on the company? Whether any of my debts will not be collected is also a worry which we are looking at. Another client was asking a question: what is the impact of the war on the financial statements? Another company has asked, what is the impact of the recent development which is being discussed on a particular group of companies, and any related ancillary work which I am performing on to that particular company, how I will be able to survive. So these are all the things which we have to consider on a regular basis. If they are following a regular accounting policy, no issues. If they are accounting for complex transaction and complex accounting policy, then we have to be a little cautious when we are carrying out an audit. Related party transactions, we have to use SA 550 and use the complete work to ensure that there is no major issues. Wherever there are areas of judgments involved or subjectivity involved or estimations involved, how we are getting the comfort, how our audit procedures have been in accordance with the standards on auditing, whether the transaction which has been accounted for is outside the normal course of business. This outside the normal course of business means one-off entry or one-off transaction being accounted for. That one-off transaction might have resulted in a huge profit in the entity in the particular year. So in that case, whether that transaction which has been accounted for outside the normal course of business is a genuine transaction is what the auditor should look at. In one of the cases where the disciplinary committee reference has gone, is with respect to a transaction which has happened with a related party, and the reviewer has concluded that who has been appointed, forensic auditor who has been appointed by the bankers have concluded that this has happened outside the normal course of business only to enable the company to show a higher profit, and based on the higher profit, working capital limits has been taken and the bank has been defrauded. The auditor could not be able to substantiate his work, whether it's a normal course of business or outside the normal course of business. So always be cautious about whether one-off transactions are happening and how you have validated. Test of controls is another important aspect. If the controls are not working very fine, you can do a minimum substantive procedure of verification of the documents, verification of vouching, verification, ledger review, etc. You can do lesser. Otherwise, you have to do extensively. That is the substantive procedure for each material class of transaction, each material account balances, each disclosure. What is the result of test of controls based on which whether substantive procedure has to be expanded, etc. You have to look at substantive procedure. Nature and timing of and extent. It is always based on what is our previous audit experience. Is there so many audit adjustments coming in? If so, we should think about having the detailed transaction audit. Whether we have covered a particular item during the interim period and only final roll forward can be done for the subsequent period, nothing to worry too much, because I have certain clients who are supposed to release their financial statement for their group companies in abroad within 14 days from the end of the reporting period. So April 14th is like bank audit where we are doing within 7 days or 4 days. How I will be able to get comfort? So what we do is 11 months audit we complete in March, and 1 month we roll forward that 11 months is expected to be on the 12 months basis proportionately. And we extrapolate that for 12 months and check what is the level of the balances as set March, that's a 12 months transaction. If there is a severe deviation or big variance, we will analyze in depth, or if it is within the normal accepted level, we will not work too much on that. And at the same time, there are other account close audit procedure which we have to perform, like cutoff procedure, confirmation process, physical verification, etc. Those we will complete during the end of the audit. So within 7 days or 4 days of closure of the books, we will be able to get a complete picture of the financial statement for the entire year. So that is what your nature, timing, and extent. This is what I'm also suggesting, where the time available for the branch auditors is lesser. Do an interim procedure and roll forward for the subsequent period. But unfortunately, what happens is majority of the branch auditors are not interested in going and doing an interim audit. They wanted to complete the entire audit within 7 days, finish off and come back. So that is where the quality is getting suffered. So we can improve upon that. What are all the latest developments? What is the analytical procedure shows? Any big variations? We used to use a technique of month-on-month analysis of each and every expenses, each and every income. If we analyze that particular pattern, if there is any heavy hike happens, then that month we have to deep dive. That is also analytical procedure. What is the previous year figure? What is the current year figure? What is the variance? Whether the variance is supported by another factor. For example, if my debtor is increasing by 100%, my sales should also increase minimum 100%. If it is not happening, something wrong with my debtor balances, right? Or my sales may be a bogus sales. So what is the result arising out of analytical procedure? Can I use sampling technique? Yes, I can use sampling techniques. We have a separate standard on sampling itself, which gives elaborate guidance. External confirmation, key reconciliations. Now you know the key reconciliation which you are supposed to perform is your sales as per your GST returns and sales as per your books of accounts. Because it is available for the income tax officer also. Your 26 AS reconciliation with the books of accounts. Your electronic cash ledger balance with the books of accounts. Your debtor confirmation is received, the statement of accounts with the book balances. Your closing cash and bank balances confirmation with the bank reconciliation statement. All those things are important. Similarly, what I have talked about roll forward, roll backward, those who are doing bank branch audit knows, if I'm doing it on 25th of March, 5 days transaction, I have to roll forward and arrive at what is 31st balance. 25th, I got the confirmation. 5 days, I have rolled forward and I got that part of my closing balance. Roll backward. I went for the audit on 7th of April. Do a roll backward of the transactions to arrive at what should have been my balance as of 31st March. So that's the way in which we look at. SA 240 also says that you have to think about using unpredictability, because every transaction, every audit procedure, client will know. Because client may also employ chartered accountants as employees, and they also learned all the standards on auditing, and they also know the psychology of the auditors, how they will look at the transactions, and accordingly some unpredictability element should be included. For example, if they believe that the auditors will send confirmation only for balances beyond so much of money, smaller adjustments can be happened with the number of parties. whatever they wanted to achieve, they can do that. But if I pick up some items where the balances are zero, or the balances are negative, or the balances are very minimal, that's an unpredictability by the client, because I'm changing my audit procedure. So that is another area of looking at. Guidance again comes from the standards and auditing. Communicating with the client, we have already discussed. What is the best practice with the standards and auditing? How we can actually do an efficient audit and effective audit, and how our work cannot be questioned by any regulator. The simple practical compliance is, I split the audit files into permanent file and temporary file. In temporary file, for every engagement, I will have a separate work paper file, and the work paper file is properly organized by means of the planning stage, execution stage, and completion stage. And of course, in the execution stage, I will have neatly based on the financial statement line items, I will have those type of arrangement. And what is the external evidences collected, etc., I will maintain in the temporary file. This, when it is tied up with the closing financial statement, which you are going to sign off, you will be comfortable that audit evidences are available. But at the same time, to ensure that all the required audit procedure, or at least the minimum required audit procedures, have been performed by your team members, based on which you are drawing a conclusion, you can always use a small checklist-based audit. If you wanted to use some checklist, my suggestion is use the practitioner's guide to smaller audit. Even though it is using for smaller audit, you can use it for bigger audit also. That is issued by the institute. WSB has issued that. You can download that free of cost and use that checklist and use it for your audit clients. Train your audit team on a regular basis. We have a practice of having training for our team members on every Saturday. The time which we are investing, we believe that will help us to ensure that our quality of audit goes up and there is no errors which we have to worry about it at a later point of time. That is what we are supposed to look at in the training of the audit team. And whenever there is an issue comes in, please consult, maybe within your office, within your partners, or if required with your peer friends who are practicing, and that will be helpful. I have seen in Madurai one good practice. Some 20 mid-size, smaller audit firms, partners have made it a practice to meet once in a week at one of the auditor's office. Maybe 20 people have to sit with congested room, but they discuss what are all the issues they come across during the course of that particular week. And if they need guidance, they discuss, or if they have resolved it, they share their experience with the others. And that is one of the best practices which I have seen. And in fact, when I went for something in Madurai, they have asked me, can I join with them? When I joined with them, I just looked at or observed the interaction which was having. It is an intense discussion which was happening. And whenever there is a technical matter which is coming in, I have also started interacting on my own without they are asking for. That becomes really a fruitful way of ensuring a best practices in carrying out the audit. And work paper file should be seriously reviewed by a senior partner so that the quality can be maintained. So that brings me to the end of my session on the standards on auditing, insights into the standards on auditing. There is one more question which has come in from Srinivasan Harinathan. What kind of documents to be obtained in case of tax audit of proprietary concern or partnership firm doing trading business, especially on inventory? Can you please provide some guidance on this? Is it mandatory to carry out the stock verification? Sir, verification of stock, according to the standards on auditing, has to be done by the client. But we have to observe the physical verification of stock for two reasons. One, whether the stock is really existing, auditor has to respond. Second is whether the condition of the stock is usable or it requires a provision, you can validate. Third, whether all the stock has been fully included in the verification sheet or the valuation sheet, that also gives a guidance. And accordingly, observing stock verification is mandatory for every audit, whether it's a small audit or big audit, proprietary firm or partnership firm or company. It is important. What you are talking about is what kind of documents you have to have. Just look at the standards on auditing, which was talking about how the physical verification of inventory has to be done. There is one essay, if I'm not wrong, it is essay 601. In essay 601, they have given the guidance. Look at that and use that. That is enough. You need not invent something new. You can simply follow that. Another question about the same view on the bank branch audit. Anil Kumar has supplemented another question. In view of your clarification, does it mean that today the statutory central auditors have already carried out their audit on the CBS and have sufficient evidence to support that audit report? Sir, I'm not concluding that, but I'm saying that it is possible that because of core banking solutions are available, I can pull out any transaction, I can do any audit using automated techniques. It is possible. And accordingly, at one point of time, bank branch audit may become irrelevant. That is my feeling, because technology takes over majority of the work. You will not believe, in our audit of listed companies, previously we used to do a lot of sampling, validation, etc. Now we are using data analytic tools in Excel, and we are validating 100% of the transaction. How we are validating 100% of the transaction? The only requirement is, as an auditor, what are all the questions you will ask when you are doing a ledger review? We have converted into a logical question to the system, and system analyzes those transactions, whether it is fitting into that. If it is not fitting, it takes it as an exception. So when it is possible for a normal statutory audit, why not for a core banking solution? So technology is actually taking over everywhere. And that is the reason why I mentioned that. So if there are any other questions, I will take those questions also. And in case if you are wanted to have any specific questions at any point of time, your friend is always available in Chennai with his contact numbers. You can be in touch with me. I will be happy to explain to you over phone any of the situations where you have to take some guidance or some way of handling a particular situation. And in the chat box, I think that there are some questions also. Okay, this is actually an appreciation. Thank you very much, Ritesh, for the appreciation. So I now hand over the proceedings to the chairperson. If there are any other questions, I will be happy to take questions.
I think you have answered all the questions, sir.
Okay, thank you.
So on members, on behalf of Bangalore branch, I would like to take this opportunity to thank our speaker of today's program, CA Chinnaswamy Ganeshan, sir. First of all, thank you so much for accepting our invitation and with such a short notice and coming forward to address the members. And also, I would like to wish all the women participants of today's program happy Women's Day, and all the women's CAs happy Women's Day. And now I request our secretary to kindly give vote of thanks.
Thank you, Chairperson. Actually, that was a fantastic deliberation on practical insights into standards on auditing. That comes only with your personal experience, personal practical experience rather, or 3 decades in the field of auditing, sir. I thank you personally. It was a fantastic session. On behalf of Chairperson and Managing Committee of Bangalore branch of SIRCFICI and esteemed participants, I thank CA Dr. Chinnaswamy Ganeshan, sir, for his excellent deliberation for 2 hours. Thank you so much, sir. And I also thank all the participants for actively participating and then taking their time out in getting their updating their knowledge. I thank you one and all. Keep supporting us. And yeah, before I conclude, we have a program on 18th of March, Saturday, on hands-on training on Excel for bank branch audit by CA Venugopal ji. We have 3 hours of CPE for that, and then we have 1-day seminar on bank branch audit on Saturday, the 25th March 2023, and we have 6 hours CPE for that. I request the participants to kindly register for the same. And then with that, this session is getting completed. I thank you one and all once again. I, Natyam Haldur, Secretary of Bangalore Branch, sign off for the day. Thank you.
Thank you, sir. Thank you all.